Hello, and welcome to a special presentation by SCA on current market obstacles and achieving success in affordable housing. My name is Robert Ellis. I'll be presenting today. I'm a senior compliance consultant with Spillane, and this topic is near and dear to my heart, and I thank you for taking the time to tune in today. I'll be discussing the current market conditions that are facing low and moderate income individuals and families, and the difficulties lenders currently face in trying to provide credit to these segments. Affordable housing is currently a hot topic, and I hope you glean some valuable insight and useful information from this presentation. So on the agenda today are, number one, going to start with the messaging coming out of Washington and regulatory agencies. Next, I'm going to get into specific data components of the current lending environment for mortgage originations. I'm going to tackle items such as the MBA's Homebuyer Affordability Index, housing debt, which is made up of principal, interest, taxes, and insurance. I have a segment on the recent increases in closing costs, data on property values versus income. I'm going to pretty much cover the current state of anything that goes into approving a mortgage loan. All this data is critical, and I'm presenting it not just as a snapshot of what's going on now, but also where we have been just in the past couple of years and how it has become increasingly less affordable to get a mortgage. Certainly high interest rates get the headlines, but I'm going to cover all the other key data involved. And then I'll wrap up with some recommendations to implement after seeing all this data and some things you can do to hopefully try and tackle this issue. I especially want to convey that although this data is daunting, you still should be optimistic with hope that you can be very successful in fulfilling your community needs despite the odds. So let's get started. Now there's a clear message coming out of Washington and the agencies. Many speeches, many financial institution letters, and communications have come out from the OCC, NCOA, FDIC, and CFPB with a clear message that lenders should be tackling this topic with programs on economic inclusion, affordable housing initiatives, and especially doing more in these areas. So the expectations are clear. Washington is giving a message to do more, and examiners will be reviewing for this during their next exam. So the first item I want to tackle is mortgage payment affordability, and according to the most recent Mortgage Bankers Association Purchase Application Payment Index, homebuyer affordability declined in March and has been steadily declining month after month over the past few years. This index is a measurement of how new monthly mortgage payments vary across time compared to income, and I happen to like this index. As an example, the MBA reported that in February, the national median payment applied for by purchase applicants increased by $17 and is up by over $100 from 1 year ago. That might not seem like a lot, but for a low-income person in Middlesex County, Mass., that amount might be the difference between an approval or denial. So what does this mean? Well, an increase in the MBA's affordability index is reflective of declining borrower affordability conditions. And this slide clearly demonstrates how you can see jumps in the affordability index. So just to explain this graph, 2012 is the baseline starting point, and all states start at 100 as the baseline and is the black line across the x-axis. So declining index year over year means things are more affordable, and increasing the index means less affordable. Pretty basic, and I think this is a good visual. So you can see from the green line in 2021, some states became more affordable over the 9 years as the index actually decreased, states like Connecticut and Vermont. However, when you look at the blue line for 2022, there's a significant jump in this affordability index. Then things remain pretty much steady in 2023, which is the purple line. But then we have another jump just in the first few months of 2024. The graph represents the least affordable states are on the right, which we have Massachusetts, Maine, New Hampshire, and Rhode Island as unfortunately unaffordable states by this index. Next, I want to talk about property taxes. And according to Adam, which is a property data collection company, their most recent data shows single-family home property taxes were up nearly 7% in 2023 from 2022. And this increase was almost double the 3.6% increase from 21 to 22. In addition, last year's 7% increase was the largest in the past 5 years. This data shows the average tax on single-family homes in the United States increased to just over $4,000 annually. And that's the average across the nation. Here in the Northeast, we have, unfortunately, the most expensive states. Here are the top 5 highest single-family tax states in the nation: New Jersey, Connecticut, New York, Massachusetts, and New Hampshire. New England has 3 of the top 5. Next, let's look at increases in homeowners insurance. According to Freddie Mac data, back in 2018, the average homeowners insurance premium was a little over $1,000 at $1,081. However, by last year, the average annual premium is up over $1,500 annually. That amount is 10% higher than last year and up 40.8% higher from the 2018 figure. So there is a correlation between higher property values and higher homeowners insurance premiums. However, as I'm going to demonstrate later on, you don't have the same rate of increase as incomes to compensate for these jumps in insurance premiums. And just to demonstrate my point, let me ask you a question. Are you currently making 40.8% more today than you were in 2018? I'd venture to guess I don't think so. And again, this is another obstacle for those that are in low and moderate income categories to obtaining credit when you have these types of increases in the mortgage approval process. So I've talked a bit about taxes, insurance, and decreasing affordability, and all looks a little morose. However, I do want to report it's not all bad news, because last year the FHA reduced its annual mortgage insurance premium. They reduced it from 85 basis points a year to 55 basis points, which reportedly benefited approximately 850,000 FHA borrowers and saved those borrowers on average $800 annually, which is some bright news. But although they did adjust the mortgage insurance premium, they did not adjust the upfront mortgage insurance premium, which stayed at 1.75%, which leads me to my next subject of increases in closing costs. So looking at data from the CFPB, which comes from HMDA data, we can clearly see how closing costs have really skyrocketed just in the past couple of years. And this is really an excellent source of data, and again, another eye-opening graph to show just how recently closing costs have jumped. According to the CFPB, from 2021 to 2022, closing costs increased 21.8%. And then for the first quarter of 2022 to the third quarter of 2023, conventional conforming closing costs have gone up 27%. And I want to highlight that FHA closing costs have gone up 28.6%, the biggest mover. And this is a graph from the CFPB's website, which I think really demonstrates how you can see since 2021 how closing costs have really jumped. You can see the spike starting from that time period because looking back to 2018, closing costs were relatively flat. A little bit of a dip in the last couple quarters of 2020, but starting the first quarter of 2021, you can see how they've gone up. And this data correlates to the other items I've talked about with taxes and insurance and affordability, and how just in the past few years, how staggering this data for mortgage applicants has become. Next, I want to quickly talk about property values and how they've outpaced income. This slide represents how median family income has gone up compared to median appraisal values. And I've specifically taken an example from the Cambridge Newton Framingham MSA and took a specific census tract and looked at the median family income and how that's increased from 2020 to 2023, and compared it against median appraisal values for purchases in this census tract located in Middlesex County, Mass. You can see both have increased, but appraised values have outpaced incomes by 7%. This again is another factor that contributes to financing a home being less affordable when incomes aren't keeping pace with all the increases associated with these transactions. So I've gone through a number of items that relate to getting mortgage financing and how sharply things have gotten less affordable. So now I want to take a specific moderate income census tract located in Middlesex County and going to take a look at factual data from this census tract and demonstrate the difficulty in approving a loan in this geography. So the assumption is you have an average applicant, an average home value, and valid statistics on property insurance and taxes. So to start with, according to data from the FHFA, The median appraisal value was $465,000. I'm also starting with assumptions that they'll be 20% down, which leads to a loan amount of $372,000. Using Freddie Mac data, the U.S. weekly average 30-year rate as of the end of 2023 was 6.61%. That gives you a principal interest payment of $2,378. Now you also have to add homeowners insurance and also monthly taxes. And for the tax value, this is an actual tax rate from the city that this census tract is located in. So from this data, your front-end housing debt-to-income ratio comes to 40.6%. That's pretty high, but you still need to consider other debt like auto loans and credit cards, etc. I happen to add just a round number of $500, which may or may not be realistic. And this will give you a total monthly debt of $3,337. So this is a hypothetical example for 2023 in a moderate income census tract, which gives you a total back-end debt-to-income ratio of 47.8%. That's going to be above most approval thresholds for debt-to-income just to start with. And remember back on slide 4 of this presentation, the 108 increase in mortgage and payments? Subtract the 108 and you get into the 45's DTI range. That could make a difference. But we can't stop there. There is other information from this census tract that definitely needs to be considered. So again, it's a moderate income census tract, and some other key obstacles in lending here are things like the owner occupancy rate is low at 42%. There's also a significant population below the poverty line at 17.6%. And then you've got to consider the competition. The competition level in this census tract is very high. There are 9 different banks that have 16 branches in this area. There's also 8 different credit unions with 11 branches. There's also a few mortgage licensees that are competing for loans here. So this is a prime example of an average applicant in a moderate income census tract, and this is the data confronting being able to originate loans in this area to moderate income individuals and families. I also used in this example the assumption that the applicants had $93,000 to put down as 20% of the purchase price to avoid PMI. Please note that's more than their annual average income of $83,000, which may and may not be realistic. But I think this drives home the point of the current difficult economic situation. So in conclusion, it's important to be prepared to have conversations with your examiners about this situation, because when they come in, they will ask what you are doing about affordable housing, and your data might not reflect success in this area. However, despite the barriers facing lenders, there's truly much hope and optimism in serving these areas, and many ways to achieve success. So some of my recommendations of things that you'll want to consider is, number 1, have an outreach program to local housing agencies. And pretty much every town in Massachusetts has a housing authority. Reach out to them and start discussions with what they see as the community needs and ensure they are aware of the products and services you offer. Number 2, do a community needs assessment. These exercises are critical and very valuable tools. Number 3, make sure you have policies around your loan officers and their outreach efforts, and that they're assigned to cover low and moderate areas, and that they're doing outreach to the local area real estate agents. And track and document their connecting with them and having meaningful interactions. Making sure that the real estate agents understand the products that you offer, and that the LOs are also gleaning information from these agents and trying to understand the needs of these areas is key. This way you can document to examiners your efforts to bring products and services to these areas, despite the many obstacles in the way. And it may very well be the message from these communities is that home loans might not be the greatest need. You could get feedback the small dollar loan program is needed most. And I can pretty much guarantee that if you do these outreach efforts, hear such needs as a small dollar loan program, then develop, implement this product, and originate some volume, you should get some positive exam comments from your examiners, and will be reflective very favorably during your next exam. So there's definitely hope out there. You just need to tell your story and document it. And lastly, don't go at this alone. It can definitely feel daunting when you're faced with these obstacles, but this is something that I help clients with on a regular basis. And it's important to note that different institutions require different action items, because there's no cookie-cutter approach to this, and no 2 institutions are identical. Needs can be vastly different depending on the circumstances. So please feel free to reach out and engage SCA. We're here to help. This slide is a list of the links to all the data I quoted today. If you don't have a copy of the PowerPoint, please contact us and we'll easily provide this to anyone upon request. So again, my name is Robert Ellis. I hope that you enjoyed this program and presentation. And please don't hesitate to contact myself or Bill Dolan if you'd like to discuss further any items associated with putting together a community needs assessment, or discuss items like fair lending issues or CRA issues, and or preparing for your next exam. I look forward to talking to you in the near future. Thanks again for watching. Take care.